Good afternoon, traders, and it's an interesting setup that we've got in financial markets at the moment. The bulls have wrestled back control, and it's really a huge outperformance that we're seeing from emerging markets. The epicenter of this is twofold. One is what's happening between US and Sino relations, and that's going to unfold over the next 48 hours. If we see, signs that these two parties are a million miles apart, perhaps it can take some of the wind out of the risk-on rally we've been seeing. But of course, on the other side of that, if we do see signs of convergence around IP and also around the trade relations, then we could see some positive gains, and we'll be keeping our eye on what's happening in the US dollar CNH cross. I think that's going to be a really good barometer about what's been happening between the two relations there. The other one, of course, is what's happening from the Federal Reserve, and I don't think it's going to surprise anyone really that the Federal Reserve have adopted this kind of patient wait-and-see stance from the Fed statement. We've heard so many different Fed officials coming out with this kind of wait-and-see mantra that it's really just aggregated all these different views into one statement. The fact that they've changed their forward guidance and moved the idea that the gradual and further rate hikes are warranted, again, that's not going to surprise anyone at all. So we've come down to this kind of wait-and-see approach, this sort of disciplined approach to understand that they want to raise rates. They want to be in a position to raise rates. They just need the economy and the backdrop to warrant that situation. The other thing which I think is a game changer, and I think why markets have responded, is the fact that they see the terminal size of the balance sheet much higher than what they saw before. Now that's a function of the demand for reserves and the banking, commercial banks and Fed banks needing higher levels of reserves, so that terminal balance sheet will be higher. Therefore, the runoff which people had been expecting to come down to about $3.5 trillion should be much higher than where that situation is. In fact, the Federal Reserve has said if need be, they can actually adjust the pace of the decline, and I think that's one of the big talking points for 2019, which I've been flagging for some time, is one of the game changers is around liquidity, what's happening with excess reserves, and that boils down to what the Federal Reserve ultimately do with their balance sheet. Of course, there are other actions they can do. They can look at selling out of their sort of longer term treasuries and therefore looking to steepen the yield curve and make the banking sector more profitable, but they've already declined to say that's not going to happen anytime soon. But the market is of the belief that if the economy continues in its current trajectory and financial conditions continue to tighten, then we'll probably hear an announcement they're going to stop reinvesting, or they're going to stop normalising that balance sheet at current levels or near current levels sometime soon. And that would be a game changer. There's no denying what we saw in financial markets. Front-end yields, if you look at two-year yields, dropped 7 or 8 basis points. We saw a bit of a steepening of the curve on that function alone. If you have a look at the US dollar, obviously we saw the US dollar falling mostly against high-yielding emerging market currencies. We saw really big gains coming through in the South African rand. In G10 FX, we saw the Australian dollar being the sort of vehicle of everything emerging markets and having a strong gain. And we also saw in the rates market the implied prospect of a rate hike in 2019 this year coming down from around 7 basis points to around 2. So the market is firmly of the belief that we are very much in a wait-and-see structure. There's going to be no more hikes for 2019. Now, what's really important to me is if you have a look at 2020, you can see 19 basis points of cuts being priced in. And if you have a look at the US markets and growth over the last 30 years or so, what you tend to see is a situation where the Federal Reserve will pause for an extended period of time, and they will always start cutting the Fed funds rate into a recession. And if we look at the way that the rates market's structured at the moment, they're saying that there's going to be an extended pause with a rate cut in 2020. So the rates market is telling me that the prospect of a recession is certainly very elevated, and this playbook that we see time and time again before a recession is very much in rates pricing at the moment, and that's something that keeps us a bit concerned. But the idea that the Federal Reserve can use its balance sheet and change its balance sheet structure to change liquidity dynamics is what markets are enjoying at the moment. Okay, you can throw in the fact that we've seen better earnings coming from S&P companies, and there's a whole raft of them coming through this week and will continue to do so. And we've also seen signs of stabilisation in inflation expectations. If you have a look at five-year break-evens, they've pushed back above 2%. But at the same time, I think that's really down to what we've been seeing in the oil markets. And as I say, if we can get a break on the US crude price above 55.55, which is a 38.2% retracement of the Q4 sell-off, that will continue to push inflation expectations higher. The other big point is, I think, which is really interesting, is the idea that inflation expectations have seen a bit of a move higher recently in line with this kind of risk-on sentiment we've been seeing in the higher oil price. but actually nominal bond yields have been falling. And as a result, what we've been seeing is real yield has been falling pretty hard. Whether you're looking at 5-year real yields or 10-year real yields, they've been falling like a stone. And that's really, really important when you're looking at the cash flows of S&P companies to be able to discount them using a risk-free rate. And if we use a real rate, you know, it basically makes the cash flows of S&P companies, or the price of money, should we say in this case, that much more compelling on a relative basis. So what we're looking at is this collapse in high yield credit spreads relative to investment grade spreads, this collapse in real yields, and that's making emerging markets look pretty good. It's making the dollar less attractive, and it's making the S&P also pretty attractive in that situation. And if you have a look at the S&P now, you can see it breaking out not just of the September downtrend, but you also see this consolidation range that we've been seeing, and a little breakthrough there. So it wouldn't surprise me if high yield credit spreads continue to contract relative to investment grade, the S&P is going to continue to climb, and basically anything to do with growth, you know, mining stocks and energy stocks will continue to do quite well. Industrial stocks should do quite well in that situation as well. Of course, we will see what happens in this China-Sino relations, and the backdrop of global growth being a concern isn't going to change anytime soon. But if we're looking at what the Fed's doing with its balance sheet, what they've told us today is they've effectively thrown in the towel. They've surrendered to markets again, and they've shown us that liquidity conditions need to improve, and that's something that we need to look at. The other thing, of course, is what's happening in money supply. Global money supply has been falling, but we'll have to see if that can change around. So it's liquidity that drives markets. Markets are driving the central bank, and we've seen that again. What continues here, but certainly we've seen a risk on rally. I'm watching real yield. I'm watching what's happening in investment grade spreads. I'm watching what's happening in the S&P, but certainly it shows that the markets have won over again against the Federal Reserve.